Today, we're going to talk about the dual mandate as it pertains to maximum U.S. employment with our chief equity strategist and economist, John Blank. John, for those who don't know, what exactly is this dual mandate all about?
Well, in the 1977 Federal Reserve Act, when they updated it, they have now, and not every central bank has a dual mandate here. They always have some mandate, but ours has a dual mandate. And that is for stable prices, which is now set at an expected 2% annual core PCE inflation rate, and then maximum employment, which is, basically, keeping the household employment rate, between 3.5% to 4%, but it's a more general mandate just for maximum employment, which then means, in truth, they actually look at a lot of labor market indicators, whereas the other mandate, the stable price measure, is actually pegged much more distinctly around the 2% core PCE rate. The maximum employment is just a concept that has a lot of data that they look for to support it.
So it's been said that high levels of employment are key to a vibrant economy. But if what I'm understanding is correct, the Fed has not set a numerical target for this mandate of maximum employment?
No, like I said, they generally, all the data they will look at will kind of proxy in with 3.5% to 4% unemployment. We're at 4.1%. They're very much at the top end of where they're comfortable. I think they still are comfortable, but we did get news today, Terry, that the weekly unemployment claims rose to a 3-month high last week. So we are seeing some weakness that will probably start to cause that house unemployment rate to drift higher in the weeks ahead. So I would tell you that, they're definitely going to be very careful about watching all the data on labor markets for the next month or so as a result of what we saw today.
And today is February 27th, by the way, for those following along on the calendar. So what are the indicators that tell the real story about this issue?
Well, generally, Terry, it's the non-farm payroll monthly number that is from the federal level that is most salient, and it's usually the rolling average of the last 3 months, which is currently around 225. And as long as that stays above 125, 150, you're in a place where the Fed believes momentum is strong for hiring and the labor market's in a tight place, and they will generally be happy with it. So, like I said, from a backward-looking perspective, they're comfortable, but they've got very high-frequency weekly data that's starting to cause them for some concern, and they will start paying more attention to things.
So based on conclusions from all the data they look at that we can draw from this indicator and others as to the current state of U.S. employment, do you think the labor market is on a solid footing?
Yeah, I do think so, Terry. Obviously, I'm with the Fed in this idea that we really got to start to be vigilant. We've got, the Department of Government Efficiency layoffs that are not baked into that number yet, and we don't know what else is in store for that. Now, we also don't know that the calendar cycle in the private sector, typically in the early parts of the year, there are some layoffs. We saw and heard of, for example, we've heard of 1,000 out of Starbucks. So I am very much in a wait-and-see mode in the next 2 months in terms of labor market indicators.
All right. At this point, overall, what is the bull-bear story on the U.S. economy?
Well, the bull story is that latest earnings are extremely good, Terry. 13.6% earnings the core fourth quarter, and a look for double-digit earnings across the entire year. So that is the bull case, that companies are making a lot of money in a full employment economy. The bear case is that the uncertainty introduced by, tariffing everything, constant news flow about layoffs and federal employment reductions and reviews is going to cause, it already has caused some consumer pullbacks and some stocking in advance of tariffing, and all of that can lead to weakness in this economy down the road.
We no longer have a Treasury yield curve. Does that mean that there's no recession concern on the horizon?
No, it doesn't, Terry. It just means that particular forward indicator is not didn't work for this cycle, which was unique because it was a supply shock cycle, not a demand cyclical cycle. And right now we've got a new catalyst that has nothing to do with COVID. It has to do with the change of administrations. And so that can introduce a new dynamic to the business cycle that has nothing to do with COVID, period.
And is that a major concern now regarding the U.S. economy for you?
I think it's probably the number one concern for the U.S. economy, yes. I think this administration has raised a lot of concern because of what I'm talking about, a double whammy. One is raising prices on import goods, Mexico, from Canada, from Europe, from China, all of the major trading partners of the United States, and from a wholesale, ongoing, and very unprecedented federal employment review that has yet to seem to take its course. And again, it's very hard with an administration that loves to push sound bites out there to know what is noise and what is signal and what they're actually going to do. And anybody who knows markets knows that, on top of those two drivers, tariffing and the actual employment reductions, is just the sheer uncertainty of what is going to happen. And that is literally a third negative catalyst.
Based on retail earnings out so far, do you see any red flags concerning the state of the U.S. consumer's health?
I certainly don't. I mean, if you take Amazon out, you have a very strong set of earnings numbers from the retail names that we've gotten out in the last few weeks. So that gives me a lot of strength to think that, again, at least at this point in time, the retail spending is holding up. But again, Terry, those are reports looking back and not going forward. And in light of the uncertainty, we can see a lot more caution, as the data comes in for the next few months.
More strong buy stocks you're watching include Plains All American Pipeline, BJ's Wholesale Club, and Pilgrim's Pride.
Yeah, Plains All American, ticker PAA, is the number one ranked stock. We've got a nice upgrade on first quarter and second quarter earnings, 5% and 10%. And a nice look at this year's earnings, a flow through all the way 10% up. So very strong upgrade to earnings here, Terry. And you got a target price at 23 when it's priced at 20, and it's already an A for value. So at a 13 PE ratio on a forward look, this is a name you should be looking at.
And BJ's Wholesale Club.
BJ's Wholesale Club, we did mention retail, and what you hear not are here to find out is that their price earnings ratio is 24. So, it's a well-priced retail stock, but it is the wholesale club stock. The Costco's and wholesale clubs like BJ's are where people seem to be stocking up a little better. So I think short-term this stock is rightly ranked as a number 2 ranked stock, but I would be a little concerned about it as a long-term buy right now because I think it's a little too rich.
Pilgrim's Pride.
Pilgrim's Pride is one of the largest chicken companies in the U.S., Mexico, and Puerto Rico. And it makes $5.50 a share in earnings, and right now it's $54 a share. So that's $10.50 a share in a price earnings ratio. Again, this is if you're looking for a low beta stock in a consumer staples area with an A for value, A for growth, and number one Zacks rank, you got to look into a name like this. Again, I probably would not be a buyer at the $54 level. I think it's at its target price. But if we get a pullback to 45 on a name like this, I would definitely be a buyer.
Our chief equity strategist and economist, John Blank, on the dual mandate and the economy. And with John, I'm Terry Ruffalo. Here's something for you to check out. Zacks 7 Best Stocks for the Next 30 Days special report is available for downloading. This just released special report names 7 tickers and can be downloaded for only $1. Find out more details at Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.